Every week, without thinking about it, most of us spend $20. Coffee, fast food, subscriptions we barely use. It feels too small to matter. And because it feels small, we never ask a more important question. What if that same $20 had a job? What if, instead of disappearing, it quietly worked for you every single week? What if that habit could eventually produce thousands of dollars a month in income? In this video, I'm going to show you exactly how that can happen. Not through motivation, not through risky bets, but through a simple, repeatable system built on dividends, reinvestment, and time. This isn't about getting rich. It's about turning a small weekly decision into long-term financial and mental stability. Most people think the purpose of investing is growth. They want their money to go up. But growth alone doesn't pay bills. Growth only becomes useful when you sell something. And selling creates a problem. Once you sell, that asset is gone. Income works differently. Income shows up without forcing a decision, without timing the market, without selling pieces of your future. Dividend income is money that arrives simply because you own productive assets. It reduces pressure. It creates breathing room. It gives you options. That's why the goal here isn't to beat the market. It's to build steady cash flow. Money that shows up whether markets are calm or chaotic. Money that supports your life instead of sitting on a screen. Now let's talk about why this starts with just $20 a week. $20 is intentional. It's small enough that it doesn't disrupt your life. Small enough that you won't quit when motivation fades. Most investing plans fail, not because the strategy is bad, but because people can't stay consistent. They start too big. They feel pressure. They stop. Consistency beats size. A small amount invested every week for decades will outperform large amounts invested inconsistently. And $20 a week removes the psychological barrier that says, this isn't worth it. It is worth it. Because it's not about the amount. It's about the habit. To make a small weekly investment work, the strategy has to be simple. And it has to produce results without requiring perfect timing. That's where dividends come in. When you buy a dividend-paying stock, you're buying ownership in a real business. When that business makes money, part of the profit is paid to shareholders. That payment is the dividend. It's not a bonus. It's not extra. It's money the company already earned. The first thing to understand is dividend yield. Yield is simply the income you receive compared to what you invested. For long-term investing, a yield between 3 and 5% is generally healthy. High enough to produce income. Low enough to remain sustainable. The second piece is dividend growth. This is how much the dividend increases over time. A growing dividend protects your purchasing power. It means your income rises without you adding more money. The third piece is share price growth. Strong companies tend to increase in value over long periods. That growth supports future dividends by keeping the business strong. When yield, dividend growth, and price growth work together, income compounds naturally. The real accelerator in this strategy is something called dividend reinvestment, often referred to as DRIP. Here's how it works. Instead of taking your dividend payments as cash, you automatically use them to buy more shares of the same investment. Let's use a simple example. Imagine you own 100 shares of a stock priced at $20 per share. The company pays $2 per share per year in dividends. That means you receive $200 in dividends over the year. With reinvestment turned on, That $200 buys 10 more shares. Now you own 110 shares. Next year, those extra shares also pay dividends. At $2 per share, you now receive $220. Reinvested, that buys even more shares. Nothing changed except one decision. You let the income buy more ownership. That's compounding. Your income grows because your share count grows. Your share count grows because your income keeps working. This process is automatic, emotionless, and powerful over time. When prices fall, dividends buy more shares. When prices rise, your existing shares are worth more. Either way, you're building. Of course, reinvestment only works if the businesses behind the stocks are strong. That's why portfolio structure matters more than chasing high yields. Instead of guessing individual winners, this strategy focuses on categories. Blue chip companies form the foundation. These are established businesses with steady demand and reliable cash flow. Dividend aristocrats add consistency. These companies have increased dividends for decades through good markets and bad. High-yield stocks are used carefully. Not extreme payouts, but sustainable income that accelerates early cash flow. Growth-oriented dividend stocks focus on the future. Lower yield today, but faster dividend growth over time. Diversification across these categories reduces risk. No single stock controls the outcome. To make this real, let's look at a simple example portfolio. Imagine a small group of dividend-focused holdings, equally weighted. Each one serves a role. Some stabilize income, some accelerate growth, some balance risk. Yields fall within the 3 to 4% range. Dividend growth averages in the low double digits. Share price appreciation remains steady over time. Nothing flashy, nothing speculative. Just businesses doing what they've done for years. Now let's talk about the math. When a portfolio is equally weighted, calculating averages is simple. Add the dividend yields together and divide by the number of holdings. That gives you the portfolio's average yield. Do the same for dividend growth. Do the same for price appreciation. You don't need complex formulas. You need clarity. This simplicity is important because it keeps you consistent. If you understand what's happening, you're more likely to stay invested. So what happens when you invest $20 a week and let this system run? In the first year, you invest about $1,000. At this stage, growth is modest. The habit is what matters. After 10 years, the portfolio grows into the tens of thousands. Dividends are still small, but they're starting to contribute. By year 20, something changes. Reinvested dividends begin to accelerate growth noticeably. The income starts doing real work. By year 30, the system reaches maturity. At that point, projections show a portfolio capable of producing thousands of dollars per month in dividend income. Not by selling assets, not by timing the market, but by letting ownership compound. This is what patience looks like in real life. This challenge isn't just financial, it's mental. Investing $20 a week in yourself builds confidence. It builds discipline. It builds proof that small, consistent actions matter. You stop seeing money as something that disappears. You start seeing it as something that works. And that mindset compounds just like dividends. If you want to see how a similar strategy can generate $1,000 a month using even smaller daily amounts, watch the next video on the screen.